The Japanese yen is currently in a precarious position, having plunged to a multi-decade low and testing the psychologically significant 162 level against the US dollar. In response, the Bank of Japan and the Ministry of Finance are reportedly implementing mini interventions to counteract this decline. By the end of this video, you will grasp the intricacies of these tactical moves and understand why shifting Fed rate hike forecasts are complicating the BOJ's efforts more than ever. So, why are we seeing this decline right now? The yen is at its lowest level in over 40 years, and this isn't just a localized issue, it's part of a broader global macroeconomic shift. Earlier this year, in April and May, Japanese authorities spent an astonishing 11.7 trillion yen defending the currency. Yet, the fundamental pressures stemming from the interest rate differential between the US and Japan persist, pushing the dollar higher and leaving the BOJ cornered, just as their reserves come under unprecedented scrutiny. Reports suggest that targeted yen buying is taking place around the 161.80 mark. Unlike the massive interventions we've seen in the past, these mini-interventions are tactical moves aimed at leaning against the wind to mitigate disorderly volatility. Meanwhile, there's a significant shift happening in Washington. For the first time since 2023, more economists are now forecasting Fed rate hikes rather than cuts. This hawkish shift is exerting tremendous pressure on global risk assets and complicating the Ministry of Finance's fight to maintain the 162 level. On social media platform X, the mood is palpable with tension. Macro analysts are cautioning that when a full-scale intervention occurs, it often happens overnight and can shake the market violently. Traders have noted that, despite the BOJ's record spending, the market remains relentless in testing their resolve. However, some Japanese traders have observed a slowdown in yen selling as the prospect of a 1% interest rate hike from the BOJ begins to take hold, indicating that policy tightening might be the only lasting solution to the currency's downturn. Financial strategists emphasize that these mini-interventions are crucial for protecting the 162 level and combating imported inflation. However, as long as the policy gap between the US and Japan remains significant, the dollar will likely continue to be the favored choice. Experts point out that the BOJ has already tapped into considerable reserves, and while these tactical maneuvers can slow down the descent, reversing a trend driven by fundamental rate differentials is no easy task. The spotlight now turns to whether the BOJ can shift to a more aggressive tightening strategy to bolster the yen. The yen's weakness presents a double-edged sword for the Nikkei 225 index. While a weak yen can benefit exporters, the current climate raises concerns about a sharp carry trade unwind. Should an intervention trigger a sudden reversal in the US dollar to Japanese yen rate, it could lead to significant liquidations in global equities and Japanese stocks. Already, traders are witnessing signs of yen carry trades unwinding amid a generally weak stock market, suggesting that the relationship between FX volatility and equity stability is tightening as we approach the critical 162 mark. The yen's decline to 40-year lows isn't merely a domestic issue. It has far-reaching effects on other Asian currencies and global bond yields. The recent change in US rate hike expectations has tightened global financial conditions. With the Fed signaling a stance of higher for longer, the risk of erratic movements in the FX market looms large. Global investors are on high alert, as a sudden surge in the yen could trigger a major reallocation of capital from US Treasuries back into Japanese assets, impacting yields across the board. For individual investors, the primary concern is volatility. With the 162 level being defended through mini-interventions, warnings to watch for it are becoming increasingly common. Overnight moves pose the greatest threat, often occurring when liquidity is at its lowest. It's crucial to remain cautious in positioning, paying close attention to the narrowing or widening of the policy gap. Keep a close eye on the narrative surrounding a potential 1% rate hike. If the BOJ acts more aggressively than anticipated, the yen carry trade could unravel quickly, ushering in a drastically different market environment than we've experienced since 2023. Now, let's explore AI-driven scenarios for the months ahead. In our base case, the BOJ and MOF will continue their targeted mini interventions, keeping US dollar to Japanese yen around the 162 mark as long as US economic data remains robust. This would result in ongoing high volatility without an immediate collapse. In a bearish scenario for the yen, if US inflation accelerates again, the Fed may be forced to hike rates, potentially breaking the 162 barrier regardless of intervention, leading to a flight to the dollar. Conversely, a bullish scenario for the yen could emerge if the BOJ raises rates to 1% or more, coupled with a cooling US economy, which could trigger a swift unwind of carry trades and a rapid movement back toward the 150 range. The critical factor will be the convergence of US and Japan's policy gaps. To wrap things up, first, the BOJ is tactically defending the 162 level. Second, the Fed's hawkish shift presents a significant challenge for the yen. And third, keep a sharp eye on the possibility of a 1% BOJ rate hike, which could be a game changer. What do you think? Will the MOF spend more of their record reserves to halt the yen's slide? We'd love to hear your thoughts in the comments, and don't forget to subscribe for more in-depth analysis of Japanese macroeconomic trends.